Hey everybody, it's Daniel here from Infrares. Hope you're all doing well. So we've got the biggest live streaming company laying off a huge portion of their workforce. The biggest live streaming company out there among the younger generation. You might have heard of it, you might have not. I'm talking about Twitch. So there's this article that comes out from Bloomberg. It says Amazon owns Twitch, to cut 500 employees, which is about 35% of the staff. And move is designed to stem losses after 2 rounds of layoffs last year. So like I said, right, we saw layoffs in tech before, and it will continue. Don't think that these massive layoffs that we saw previously is the end of it. No, we're going to see more within tech, and we're going to see more within also other industries as well. But 35% is a big chunk, especially for a very, very popular company, a live streaming company among the younger generation that's been running for about more than 9 years. Now, let's get into this article. I'll link it in description so you can read up on it. But it says here, Amazon.com live streaming site Twitch is cutting 35% of its staff, or about 500 workers. Twitch CEO Dan Clancy said in a blog post Wednesday morning. The layoffs are the latest in series of job reductions there. The cuts, which Bloomberg News earlier reported on Tuesday, come amid concerns over losses at Twitch and after several top executives left the company in a span of a few months. So you got executives leaving, you got layoffs coming in. What's going on with a huge company like Twitch that was very, very successful and still is, and very popular among the younger generation, right? If you scroll down here in the article, it goes on to say, over the last year, we've been working to build a more sustainable business so that Twitch will be here for the long run and throughout the year. We have cut costs and made many decisions to be more efficient. This is from the CEO. The CEO also said, unfortunately, despite these efforts, it has become clear that our organization is still meaningfully larger than it needs to be given the size of our business. So just like many other tech companies out there, they overhired, they overtook on many things, right? Everyone did well during the COVID pandemic time, made a lot of money, and now behold, with higher rates, everyone's scaling down. And the thing is, the monetary policy from the central banks out there, they work with a lag, they take its time, and we're starting to see the effects of all this tightening that we saw in 2022 and 2023 starting to have an effect now in 2024. Now, going into the article further, it says running a large-scale website supporting 1.8 billion hours of live video content a month is enormously expensive, despite Twitch's reliance on Amazon's infrastructure, right? So you've got Amazon's infrastructure, you got Amazon that, has purchased Twitch, and it's still costing you a lot, right? What's going on there? The business also remains unprofitable more than 9 years after Amazon's acquisition of the company, according to people familiar with the company's finances. So here's the thing, right? The company's been doing well over the 9 years because we were in quite a low interest rate environment. And lo and behold, everyone got used to the free money, to the low interest rate environment. Everyone was partying, everyone was high off this cheap, very, very cheap money because the rates were very low. And as soon as the pandemic happened, inflation skyrocketed. Guess what? The Fed, the central banks out there don't give a damn. They went out and they said, we've got a mandate. We've got to meet those mandates. We've got a dual mandate. And one of them we're not succeeding on, which is inflation. And that means, how do you combat it? Well, the only tools, one of the tools is interest rates. And that's where you got the massive rate hikes. Right? So this is very, very interesting here because this is just the beginning here. And this is one prime example of a company that is not profitable, but it's been running for a long time successfully. A big startup company, and now starting to feel the pain and laying off a large amount of their workforce, all because of the higher interest rates. Now, if you think about how many more other companies are out there like that were doing well during a very low interest rate environment, right? And that are also not profitable, because now with those debt and that debt that's coming due, with the money that you owe, and especially you have to refinance, how are you going to do it if you're unprofitable, right? Very, very difficult. This is where you can expect a lot of zombie corporations come out. This is where you can expect a lot of companies to go default, to go belly up. This is where you will see the ones who over levered, who got used to the low interest rate environment, who were betting on that we would never see high interest rates, that took, during the COVID pandemic, the stimulus or the packages and over levered then, and to not hedge that risk. You will start to see in the coming months, in the year, and so on, a lot of these companies start to show up and talk about more and more layoffs, and many of them to even shut their business down, right? Just like we saw during the banking crisis last year in March. That was just the beginning of some foolishness of, some regional banks out there not hedging, not expecting these higher interest rates. So same thing. I bet you there's a lot of corporations out there that will also face the pain, that are also hoping and betting that rates will remain low. And if the time comes to refinance and the rates are not low or not what they expect, then it could create a lot of problems for corporations, which would then lead off to layoffs and then lead off to, the unemployment rate moving up higher. And we heard from the Fed also, let's not forget, that they did reiterate in its minutes, right? Some members there talked about that they see rate cuts starting more closer to the end of the year rather than March. So let's see. We don't know. Things can definitely change. We have inflation data coming out tomorrow. Let's see how that comes out. We have much more data to analyze and watch. And if that data continues to be stronger than expected, then I don't see any reason for rate cuts. And if that's, or at least rate cuts anytime soon, especially for a March one. And if that's the case, then guess what? That's gonna really, really, really throw the market into a mini tantrum, because they're definitely expecting at least one rate cut by March. And if that happens, it may not be good for the equity markets. So anyways, very interesting article here. This is one of the many tech companies out there that are unprofitable, but have been running a strong business for some time, and now we're starting to see the effects of the unprofitable companies, the high-flying tech companies, now coming to face the bill, the due date, the refinancing. You gotta pay the debt. What are they doing? They're starting off with those layoffs, and then if it doesn't work, it could end up worse. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.